Welcome back to BitcoinDorks, your daily source for crypto news and analysis. Today, we're talking about an AI trading Dapp that's been accused of being a Ponzi scheme by multiple US state regulators. The company behind the Dapp, which is called Blockchain Credit Partners, BCP, claimed to use advanced AI algorithms to generate profits for its users. However, regulators in several states have alleged that the company was actually running a Ponzi scheme. In a statement, the Texas State Securities Board accused BCP of fraudulent and deceptive practices and ordered the company to cease operations in the state. Similar actions have been taken by regulators in North Carolina, New Jersey, and Maryland. So, what exactly is a Ponzi scheme? Essentially, it's a type of fraud in which returns are paid to earlier investors using the capital contributed by newer investors. The scheme relies on the continued recruitment of new investors to generate returns for earlier investors and eventually collapses when there are no more new investors. In the case of BCP, regulators allege that the company was using funds from new investors to pay out returns to earlier investors rather than actually generating profits through AI trading. But this isn't the first time an AI trading platform has been accused of being a Ponzi scheme. In fact, there have been several cases in recent years of crypto companies using the promise of AI-generated profits to lure in investors only to collapse in spectacular fashion. So what can investors do to protect themselves from falling victim to a Ponzi scheme? First and foremost, it's important to do your due diligence and thoroughly research any company or platform before investing. Look for reviews from other investors, check to see if the company is registered with regulatory bodies, and be wary of any promises of guaranteed returns or overly complex investment strategies. It's also important to remember that if something seems too good to be true, it probably is. While the promise of AI-generated profits may be enticing, it's important to approach any investment opportunity with a healthy dose of skepticism and caution. The US regulators have accused the blockchain trading platform AI Trading of being a Ponzi scheme. The company has been accused of defrauding investors out of at least $1.1 billion, which has been used to buy luxury homes, yachts, and cars. The company claims to use artificial intelligence to generate profits for its investors, but the regulators allege that the returns are not genuine and instead are paid for using funds from new investors. According to the regulators, AI trading was created by a group of individuals in Florida who promised to use advanced machine learning algorithms to generate consistent returns for investors. The company claimed that it had a team of experienced traders and data scientists who were able to develop proprietary trading strategies that could deliver high returns with minimal risk. AI trading reportedly lured investors by offering them high returns on their investments, claiming that their money would be used to trade various assets such as cryptocurrencies, stocks, and commodities. The company also promised to use their investments to fund research and development for their AI technology. However, according to the regulators, the returns were not generated by trading profits but rather by using new investors' money to pay off existing investors. The company is also accused of using false and misleading statements to attract investors, including claiming to have partnerships with major financial institutions that did not actually exist. The investigation into AI trading was conducted by a joint task force consisting of regulators from several US states, including Texas, New Jersey, and Florida. The regulators have already taken action against the company, including obtaining a court order to freeze its assets and appointing a receiver to oversee the company's operations. The case highlights the risks associated with investing in new and untested technologies, particularly in the blockchain and cryptocurrency space where the regulatory environment is still evolving. Investors are advised to be cautious and to do their due diligence before investing in any new technology or platform. The allegations of fraud by multiple state regulators cannot be taken lightly. The regulators have accused AI trading of using new investor funds to pay off older investors and misleading investors about the platform's performance. If these allegations are true, it would mean that AI trading was operating as a Ponzi scheme and investors who trusted the platform with their funds could potentially lose everything. As the investigation into AI trading continues, it remains to be seen what the ultimate outcome will be. But one thing is certain, regulators are taking a closer look at cryptocurrency platforms and projects, and investors need to be cautious in their investment decisions. One of the most vocal critics of AI trading apps is New Jersey's Bureau of Securities, which has issued an emergency cease and desist order against the Vitals platform. The Bureau accuses the platform of offering unregistered securities and misleading investors with fraudulent claims of high returns. Another state that has taken action against AI trading platforms is Texas, where the Texas State Securities Board issued an emergency cease and desist order against Fintech Investment Group, which operates the mine. The order alleges that the company is engaged in fraudulent and deceptive practices and is not properly registered to offer securities in Texas. Similar actions have been taken by regulators in the states of Alabama, Florida, and Hawaii, all of which have issued cease and desist orders against BitConnect, another AI-powered investment platform. The orders allege that BitConnect is offering unregistered securities and engaging in fraud by guaranteeing returns on investments. While the actions of state regulators may be seen as a positive step towards protecting investors, some experts believe that the regulatory environment around AI trading apps needs to be more cohesive and standardized across states. In conclusion, AI trading apps have become increasingly popular in recent years, promising to revolutionize the way people invest. However, the lack of uniform regulatory oversight and the potential for fraudulent activity has led to increased scrutiny from state regulators. While there are legitimate AI-powered investment platforms, investors should exercise caution and do their due diligence before investing in this space. As the regulatory landscape continues to evolve, it will be interesting to see how the use of AI in investing develops in the years to come. That's it for today's video. If you found this information helpful, be sure to hit the like and subscribe button for more cryptocurrency news and updates. Thanks for watching, and we'll see you in the next video.